Hello folks, good afternoon. This is Jeff Camarda from the boardroom with another New York Minute. I'm talking briefly today about the difference between ETFs, exchange traded funds, and mutual funds. The advantages of ETFs, widely disseminated now, are that costs tend to be lower than mutual funds, some dramatically lower, but not the delta is not as much as you might think. There are some extremely expensive ETFs, and there are some quite cheap the mutual funds. So it pays to actually look at the prospectuses and Morningstar or whatever and get the relative differences. But primarily ETFs, which have significant tax advantages, by the way, as well over mutual funds and many fact patterns. But ETFs are still primarily index-driven products, actively managed funds where a manager tries to make good decisions to outperform an index are just starting to emerge now, but really haven't had enough time to develop track records to pick out any that may be superior performers. So ETFs still are very much the index products. They should perform pretty closely to the performance of the underlying index, S&P 500, the Russell, whatever index you may happen to choose. There are also the tracking errors, so you need to be careful if the model and the size of the fund that's utilized should perform as the index does, but that's another issue. Mutual funds, of course, there are many, many more of them. They've been around for probably nearly a century, and there are some expensive ones, some very inexpensive ones, everything in between, various distribution models, commissions, non-commissions, so forth. But the reason that, in my view, mutual funds still, dusty old mutual funds, still have a great deal of allure is because there's an awful large universe of actively managed funds available. And if you have a good one where the manager is able to outperform his specific benchmark through skill and good investment decisions, you can target alpha or additional investment return above whatever the applicable benchmark index is. Peter Lynch during the 1980s with the Magellan Fund really is a textbook example of an active manager outperforming the stock market in general. There's a whole lot more to the story, but we've taken too many New York minutes as it is now, so I wish you adieu, happy and healthful and peaceful holiday season. Until next time, this is Jeff Camarda from the boardroom saying goodbye for this New York Minute. Bye-bye.